Good evening, investors, partners, and well-wishers. So before I take you through the Dynamic Asset Allocation Fund presentation, I just wanted to lay out the context. So when we started the AMC, from a product philosophy perspective, we wanted to uh, fulfill two key purposes. So one, we wanted to offer a stability-focused dynamic asset allocation fund, which is quite important in today's times than ever before. And we also wanted to bring in a growth-focused flexi cap fund. So these two important propositions we wanted to offer, and then taking into feedback, we will look at new products. But primarily, our goal has been to offer both these propositions. So DAF had a very clear purpose. So it is a stability-focused fund. So, and in fact, for most of you, it'll be interesting to know that the group started in an unprecedented time. So the dot-com bubble had burst and 9/11 had played out. So Unifi as a group was founded during such a time. And as founders, sponsors, and the early set of employees, we knew the importance of a stability-focused product in any investor's portfolio. So our first strategy in the earlier avatar in our PMS, which is the sponsors' main activity, was in fact a stability-oriented fund, and it has changed. Changed vehicles, and now we are in this dynamic asset allocation fund. So I would like to share a presentation which takes you through what we have done specifically in the last 1 year. The focus in this particular fund is to deliver consistent returns across economic cycles and while keeping liquidity and volatility in mind. So capital preservation is the first, in terms of pecking order, it's capital preservation and maintaining the liquidity profile, followed by, after satisfying the first two objectives, and we would like to add value by maximizing the returns after satisfying the first two objectives. So what have we done? What are the it's easy to claim that we are offering a low volatile product, and it's a market neutral product, and it's an all-weather product. How do we do? What are the opportunities, or what are the target segments? So broadly, we have identified three different segments which will enable us to offer these propositions, which are very useful for a fixed income oriented investor. So fixed income investors seek stability, they seek liquidity, and the returns have to be better than the alternate products or alternate options. And most importantly, there has to be a tax efficiency. So keeping these requirements in mind, we have identified three target segments. So which is the highly rated debt, which helps us to ensure that the portfolio is highly liquid, and the high yield debt segment, which helps us to enhance returns, and the cash futures arbitrage segment and special situations, forming part of the equity segment, which provides us the tax efficiency, liquidity, as well as the special situation specifically helps us to enhance the return. So each segment has a specific purpose and also an optionality. Even in the highly rated segment, there are times that we can tactically use the duration and optionality and add alpha to the portfolio. Similarly, the high yield segment, it's not only about yield enhancement. We will also be cognizant of the macro environment affecting the investee companies stroke sectors, and we have the option to cut down volatility, or we have the option to cut down our exposures to this segment, and hence we even call it dynamic asset allocation. See, one of the questions that we often get is, are you dynamically moving from debt to equity? The answer is not. We have identified three broad segments, and on a steady state basis, you could find us one third each of the segment. But what is dynamic in this is between segments, between highly rated and high yield, between cash futures arbitrage and special situations. We would be fairly dynamic, taking into account the macro and micro scenarios and situations that are evolving. So this is the objective. So it is designed as an all-weather fund, and we feel all these target segments, a combination of it, taking into account the economic cycle, will help us deliver consistent outcomes. And this is the allocation as of Feb closing, Feb 2026, wherein we had almost completed a year. So like George mentioned to you, we are at an AUM of 1,154 crores. The IPO NFO, the NFO, we were able to collect about 519 crores. So we have more than doubled in the last 1 year. And the YTMs, this is as on date, as on Feb 2026, this is the YTM. I will discuss about these segments in detail as we move forward. And if you see the debt segment, so coming to the debt segment, if you see, we are in both highly liquid and high yield segment. The highly liquid segment, we are quite clear that we want to be in the mid duration, low to mid duration. So we will take into account the growth inflation positioning and accordingly choose to remain low on duration or go slightly moderate on duration. So the reference range for us, you could expect us to be between 15 months to 36 months in terms of modified duration. And that's what we have been in this range for over the last 1 year as well. And coming to the high yield, and we are very, very clear on what we want to do and what we do not want to do. We are not in real estate, we are not in venture debt, we are not in distressed debt in chasing higher yields, because this structure, it's an open-ended structure. We don't want any, we don't want to get into any situation where the payoffs are back-ended, or a close-ended structure would make more sense in taking part in those opportunities. So we have identified the alternative NBFC segment, catering to the retail and MSME segment of our economy, which is fairly liquid because they collect monthly EMIs from their borrowers. So accordingly, what we have done is we have structured amortization of principal, which helps us to maintain liquidity, as well as it also helps us to de-risk from a bullet structuring. So what is this segment? What are we talking about? So we are talking about where are we getting higher yields? We are getting higher yields in affordable housing, vehicle finance, which could be used vehicle finance as well, MSME finance, consumer finance, and microfinance. The good part is these segments are retail, so which means the ticket sizes are granular and they are geographically spread across India. So a specific issue may not, unless it's a country specific issue, if it's a region or location specific issue, it doesn't affect doesn't affect the entire sector or the entire company. And it is strategically important for the government because these institutions are delivering the last mile credit and taking part in the democratization of credit. So across adverse events, starting from say a demon or a GST transition or a COVID, government and RBI have consistently supported this sector. Several NBFCs have gone on to become small finance banks and have got integrated with larger banks and larger NBFCs. So it's become, from an alternative position, it's become a mainstream sector which are catering to the important segment of our population pyramid. And so this is going to be our anchor segment. As a group, we have more than 15 years of experience in investing in various companies belonging to the subsegments. And we are also looking at opportunities in domestic facing sectors where the domestic capex is bringing in cash flows. So we have investments in airport infrastructure. We have investments in hospitality infrastructure. We have investments in mining related companies where it's more domestic focused and are de-risked from the global cross currents that are playing out. So it's been a conscious strategy, and I would also, in another slide, I would explain a few other nuances with respect to this segment. See, on the highly liquid segment, we are the transmission of interest rates to the mark-to-market prices are quite immediate, as well as the magnitude is also quite corresponding from that perspective. So what we have observed is a very interesting situation played out. Inflation had cooled down. Indian macros were at the strongest in terms of adhering to fiscal deficit discipline or a CAT discipline. And RBI, encouraged by that, and had cut 125 basis points. But what we observed was there was an initial softening of yields. But then, due to several other geopolitical events, like, say, tariffs, or now most recently crude oil spiking up, the yield and the liquidity positioning, the liquidity situation, the yields after cooling off in the first quarter, that is Q1 of FY26, started inching up. So it's a very peculiar situation where typically when you have low inflation and repo rates are cut, typically the transmission has to take place. It did for some time, but again, the other risks took over and the yields have started to spike. So we believe that even from a near-term perspective, when we mean near-term, say next 2 quarters, the yields are likely to be range-bound and maybe in and around the current levels, because the budget clearly shows that government's gross borrowing numbers have increased beyond expectations, and the current volatility relating to crude prices and the pressure on rupee will sort of limit the regulators positioning or regulators room to defend the bond yields. So taking that into account, we are still maintaining a 2-year type of duration, and we feel that is, we will constantly evaluate whether there is a need to take it to the higher end of the range, which is 3 years, or we should be bringing down to the lower end of the range, which is about close to 15 months. So that's an ongoing debate and discussion, or an actionable item we would constantly grapple with on a day-to-day basis. So interestingly, the high yield segment does not have a like-to-like transmission when it comes to the softening of yields or a hardening of yields. That particular segment operates on the company's specific fundamentals, the quality of the promoters, their own credit rating, and the strength of the balance sheet, and the recent P&L performance. So that's why it sort of balances each other, the interest rate movements, because you have developed a capability and you have developed an expertise to underwrite opportunities coming from high yield segment. And if you see over the last 12 months, we have moved from highly rated debt. When we started, the yields were fairly high, and repo rate cuts were getting factored or getting expected. There was expectation of rate cuts. So, and our initial positioning was we were more in highly rated debt. But as and when the initial softening of yields played out, we found that it was an appropriate time to move to the high yield segment and enhance the yield to maturity of the portfolio. And that's what we have done between Q2 and Q3. You would find that when we started at the first month, we were running at a YTM of 8.2%. And by end of Feb, we were close to 9.8%. And the arbitrage and special situations, again, it's special situations is an interesting segment. And in the benign interest rate environment, we found that there have been several opportunities in the open offers and even IPOs, which we made good use of it. This slide showcases the performance, and there's been an interesting development. So the category, the dynamic asset allocation fund, has been predominantly run as a growth focused with a growth focused objective, which means most of our peers were high on equity in order to benefit from equity tax and then also benefit from the growth. And we approached it completely from a different perspective. We focused from a stability perspective. We wanted to use the flexibility to generate stable performance across cycles. That's why you will find a tier one benchmark where there is 50% open equity. And in tier two benchmark, it's hardly 5% open equity, and it has arbitrage and credit linkages. So we feel tier two is a more appropriate benchmark. And most of our partners and investors are also measuring us from a core inflation perspective. The objective of every fixed income investor is to beat inflation and tax and have real returns. Even from that perspective, core inflation has trended at 4% levels, and we've been able to meaningfully deliver more than the core inflation, even for someone who's tracking that as a benchmark. So this information is also part of our fact sheet. So this is the last 6 months return, and since inception, we have delivered between 7.73 to 8.37 as regards regular and direct plan respectively. And whereas the benchmark, tier two benchmark, which is more relevant, is we are very closer to that benchmark. So in special situations, what do we do? So some of you may be curious to know that. So there are several corporate events which have which if we track closely, we can benefit from that special situation. So the most important one is open offers, where when any control change happens in a listed company, the new controlling shareholder makes a 26% of mandatory open offer to the minority shareholders. So we diligently track all those open offers and see if there is any spread between the offer price and the market price. If there is a spread, then we start analyzing in detail and what could be the likely acceptance ratio and what time frame we will be able to capture these spreads. If both the assumptions after our analysis indicate that we can deliver a meaningful annualized return, then that offer we start participating in those offers. So the last 1 year we have had about 20 offers, and we found interesting opportunities in about 8 offers. And the second big opportunity comes from IPOs, where we have an allocation arbitrage. We are a qualified institutional buyer, and hence in any IPO, 50% goes to the QIBs, and MFs have further reservation. So we can, if we find a good quality IPO, we can benefit from there by participating in the IPO and exiting on the listing day. So if we choose to carry over the position, it becomes part of our equity allocation. We will not classify it as an arbitrage allocation. And time to time, there are other special situations where we can look at partly paid shares in relation to the futures price that's getting traded. And companies sometimes offer the bonus preference shares or bonus debentures, which is typically sold by the equity guys. So we track those opportunities and we get in to enhance the overall returns. So if you see I had mentioned that I would discuss some more aspects as regards high yield debt. So here we develop the conviction, and the most important differentiation that we bring to the table is we would look at any debt investing opportunity with an equity lens. So which means we will do a complete bottom-up research. primarily diligencing the people behind the company, the process they have put in place, the kind of board and key management people they have been able to attract, and also the prospects of the sector and the company's strengths to exploit the opportunities in the sector. So these are the typical filters, and we do it prior to our investment, and we also have a rigorous post-investment monitoring framework. So every quarter we revisit our hypotheses and assumptions, and in most of these cases, we try to do a direct deal with the company where we prepare the term sheet and with protective covenants where some things are linked to management stake, some terms are linked to the rating, some terms are linked to the asset quality, some terms are linked to the capitalization of the company. So we build in protective covenants and try investing in bilateral structures. And one thing we have realized that we would like to be a marginal lender to many of the companies. So the refinance is not an obligation. So when it comes to refinancing, we have the optionality to walk away from reinvesting if the fundamentals have deteriorated or if the sector is going through a bad phase. We need to have complete flexibility to avoid the high yield segment and look at any other segment. So hence, we have to be a marginal lender to most of these companies in order not to have any obligations.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.